If a global crisis starts tomorrow, most people will not lose money because they chose the wrong investment. They'll lose money because fear will make them do the wrong thing in the right order. And that matters, because in a real crisis, the question is not just what goes up, it's what can I still access before the doors close. Meet Mark. Mark wakes up, sees the headlines, opens his phone, and feels that animal panic in his chest. Missiles, sanctions, emergency meetings, oil surging, markets red. He tells himself he's being rational, but he's not making an investment decision. He's trying to make the fear stop. And that is how people destroy years of progress in a single morning. Now meet Sarah. Same headlines, same stomach drop, same primal instinct. But Sarah knows something Mark doesn't. When people think the world is ending, they usually confuse emotion with probability. So instead of asking, how do I get out? She asks, what has actually happened in past crises, and what order protects my options first? That one question changes everything. Here's the trap Mark falls into. The financial media does not get paid for calm. It gets paid for urgency. Fear keeps people watching. Fear creates clicks, refreshes, alerts, thumbnails, special coverage, and that seductive feeling that if you do not act right now, you'll be ruined forever. Sarah understands the business model. Scared viewers stay tuned longer. And that's why every crisis feels final. Every time, the story is the same. This is not a correction, this is collapse. This is not volatility, this is the end. But history is ruthless with emotional narratives. Markets have already survived world wars, nuclear standoffs, invasions, oil shocks, terrorist attacks, and repeated moments when investors swore this time civilization itself was breaking. And yet, the market kept going. During the Cuban Missile Crisis, the S&P 500 fell 6.3% and recovered in just 13 trading days. Across 20 major post-World War II military events, the S&P 500 fell about 6% on average, and in 19 of those 20 events, recovered to pre-shock levels in roughly 28 trading days. That does not mean crises are harmless. It means panic selling into them has historically been one of the dumbest ways to respond. World War I, markets shut down. World War II, Pearl Harbor triggered a sell-off. And still, the longer story was survival and recovery. Investopedia notes that after World War I began, stocks fell sharply, markets closed, and the Dow later surged more than 88% in 1915. It also notes that from 1939 through late 1945, the Dow gained about 50% during World War II. Another historical market study found that although the S&P 500 dropped after Pearl Harbor, by the end of the war, it had risen 62% from its level before the attack. So no, the world is ending is not an investment framework. But Sarah is not naive. She knows the real danger in a crisis is often not the market, it's the window. That tiny period, sometimes just days, between rising fear and government intervention. The moment when your money is technically yours until suddenly, functionally, it isn't. Argentina learned that in 2001. As the crisis deepened, the government imposed withdrawal restrictions. By November, withdrawals were limited to just $1,000 per month per account. Cyprus learned it in 2013. There was a bank holiday, capital controls, restrictions on withdrawals. The point is simple. You do not always get months to prepare. Sometimes you get a weekend. That is why Sarah's framework is not built around maximizing returns first. It's built around preserving access. Because if cards stop working, if transfers freeze, if banks limit withdrawals, if systems go down after a cyber attack, your portfolio performance is suddenly not the main issue. Liquidity becomes oxygen, and oxygen comes first. So step 1 is cash flow, 6 to 12 months of living expenses. Not vague comfort, not I could sell something, actual runway. And Sarah keeps $2,000 to $5,000 of physical cash at home, not because she's paranoid, but because modern conflict includes cyber warfare, banking outages, payment disruptions, and temporary system failures. If the network goes dark, paper money becomes a technology. Step 2, gold, but only 10 to 15%. This is where amateurs get wrecked. They wait until the fear is obvious, then they buy after the premium explodes. Sarah buys before panic fully prices itself in, and she keeps a small portion physical because a crisis hedge that only works if every digital layer remains functional is not a full hedge. Step 3. Defense stocks. Because here's the uncomfortable truth almost nobody says out loud. War is often a giant government stimulus program. Money gets forced into weapons, aerospace, electronics, logistics, surveillance, replacement inventories, fuel, and supply chains. That money does not disappear into the air. It lands on corporate balance sheets. And history shows investors know this. Investopedia notes that defense stocks tend to perform well during wartime, and in recent conflict-driven market moves, companies like Northrop Grumman, RTX, and Lockheed Martin rose as geopolitical tensions escalated. Sarah is not cheering for war. She is following cash flows. That distinction matters. Step 4. Energy. Because when conflict squeezes supply, energy prices can move violently, and when that happens, energy companies can print cash while glamorous growth stocks suddenly look fragile. RBC warns that when conflict disrupts oil, markets can suffer deeper losses. And Investopedia notes that in war-related market stress, oil and gas producers often rise with commodity prices. Step 5. Consumer staples. This one is boring. That's why it works. People stop buying luxury, they delay upgrades, they cut travel, but they still buy soap, coffee, toothpaste, detergent, food. Investopedia describes consumer staples as a classic defensive sector because people still need to eat, wash, and brush their teeth even when the economy hits rock bottom. Step 6. Inflation protection. This is where Sarah finishes the defense because war is not only about fear, it's also about spending. Massive deficits, supply shocks, scarcity, fiscal pressure, currency stress. Treasury Direct states that both TIPS and Series I bonds adjust for inflation, though they work differently. And this is exactly where Mark makes his next mistake. Mark hears crisis and runs into long-term government bonds because they feel safe. Sarah knows that can be a trap. The Chicago Fed explains that when wartime yield controls ended after World War II, holders of longer-term bonds suffered capital losses as yields rose. NERB also found that post-war inflation eroded the real value of war bonds so badly that nominal gains still translated to negative real returns. So no, the world is ending is not an investment framework.
So, to recap Sarah's robust framework for navigating uncertain times, Step 1 is cash flow, ensuring 6 to 12 months of living expenses and keeping physical cash on hand for immediate liquidity. Step 2, gold, allocating 10 to 15% with a physical portion as a true crisis hedge. Step 3, defense stocks, recognizing their historical performance during geopolitical tensions. Step 4, energy, understanding its volatility and profit potential when supply is squeezed. Step 5, consumer staples, a boring but resilient sector that thrives even in economic downturns. And finally, Step 6, inflation protection, utilizing tools like TIPS and Series I bonds to safeguard your wealth against rising costs. This comprehensive approach prioritizes preserving access and liquidity over chasing short-term gains, ensuring you're prepared for any scenario. If you found this breakdown valuable and want to build your own financial resilience, make sure to subscribe to Wealth Mechanics, hit that notification bell, and give this video a thumbs up. Share your thoughts in the comments below. What are your essential steps for financial preparedness? Your engagement helps us bring more valuable content to you.